Good afternoon, everyone. I hope you're finding some good opportunities to network this afternoon and share some ideas from the summit so far. My name is Jeremy Fernandez. I'm a news broadcaster with the ABC, and I'm going to be facilitating this next session, which is titled The View from the Top. Now, we're going to be hearing shortly from three industry leaders on how they're balancing the impacts of climate change across their funds and alongside their day-to-day businesses as well. But it's not just about risk management, of course. As you well know, there are some considerable opportunities to be had if the circumstances can be navigated carefully and skillfully. Now, as we approach the end of 2017, we are in an extraordinary time for change. I don't need to tell any of you that. Even this time last year, few of us could have predicted how the next 12 months, the last 12 months we've had, would have unfolded, from a Trump presidency to America's withdrawal from the Paris Climate Accord to successive natural disasters around the world, and the Australian energy crisis here that continues to rest in the hands of a fragmented and precariously balanced parliament. So uncertainty is not in short supply, and alongside that, the overwhelming science pointing to the effects and exacerbation of climate change continues to be called into question in politics and in the public. Sections of the public disbelieve the warnings of threats. There are divergent views on the urgency of action and how it should be done and what sacrifices should be made to deal with the problem. It's often simplified by the media as a toxic debate about winners and losers. And not for the first time, industry, business, corporations, investors are being looked to for signs of leadership that may be lacking elsewhere, to take on the mantle, to manage the risks and to seize the opportunities. Now, we have this very distinguished panel of leaders to talk through some of the issues. Collectively, they have about 3/4 of a century worth of experience in their field. And there will be some time after discussion to ask your questions of them as well. I'd like to introduce Debbie Blakey, the CEO of HESTA. HESTA is Australia's largest industry super fund for health and community services. She's responsible for leading its $40 billion investment portfolio. HESTA's board has recently updated the fund's own long-running climate change policy, which Debbie will talk to us about, no doubt, in a moment. Matt Weinray is the CIO of NZ Super, which is New Zealand's sovereign wealth fund. It's significant that he is the fund's first chief investment officer. Under Matt, NZ Super has been implementing a whole of portfolio approach in a $35 billion fund to managing the fund under a responsible investment framework and relying on a burgeoning evidence base of what it means to invest ethically. Damien Graham is the CIO of First State Super, which is one of the top 5 superannuation funds in Australia, open to all Australians who receive super. Damien oversees the management and strategy of First State's $85 billion management across all asset classes, along with State Plus, which is First State's financial planning arm as well. So welcome them, please. Thank you. Terrific to have you here. I think I calculated in my head earlier on, we have about $160 billion worth invested through the three of you, which is quite significant. So your insights are invaluable. Now, Debbie, as a CEO, what are the standout considerations that you take with you in HESTA's investment approach when you look out and see what you see?
Thanks, Jeremy. It's great to be here. I do feel a little bit daunted because I think there's so much knowledge about climate change in the room, and possibly a lot more than I know. But look, at HESTA we have a very long history of recognising that climate change is such a big issue for us as a country and for the global community. And this huge challenge that we face, the issue of 9 billion people by the year 2050, and how we're going to manage that with climate change and all the other pressures. So, when you talk about non-believers, I think at HESTA we are very much believers, and it's not about what climate change may do, it's very much about what climate change will do and managing that. I think there are two very broad areas for us to consider, and the first one is what you spoke about is as owners and managers of financial capital, so that investment aspect. But there is another aspect I think I have to put on the table as the CEO on the panel, is around management of human capital, both in our organisations and also, of course, in our supply chain. And I think we have to make sure that that's also very firmly on the table. So When we look at it, obviously a big part is how we invest and the decisions that we make, and making sure that climate change is front and center with those investment decisions. It's also how we influence, and never underestimating the opportunity we have through our investments, through our scale, through our brand, and quite honestly, through that voice of wisdom and reason that's at the table, because very often the voices at the table are not wise and don't have the view that we have. But it is then beyond that. It's how we operate as an organization and making sure that we are very genuine, absolutely authentic, in that what we're expecting of organizations we invest in, we ourselves are doing as an organization, and also in our supply chain. Now, I think supply chain for us as super funds, if you actually map out our ecosystem, we have very large supply chains, and there's an enormous opportunity there for all of us to do more. So, another aspect for us at HESTA is we speak a lot about managing risks of climate change, and I'm not going to play that down. Managing risk is incredibly important. But I think it's also really important to talk about the opportunity. And last week I was actually at an ESG summit in Berlin following the PRI conference. And it was really interesting because there was a fantastic conversation about responsible investment on a panel similar to ours. But it was all about managing the risks. It was half an hour of talking just about managing risk. And in fact, one of the panel members actually said responsible investing is all about managing the risks. Well, I actually challenged that, because a huge part of responsible investment is about taking the opportunities. And, we have to recognize that as investors, we actually are risk takers. Now, I'm not for a moment suggesting that the two risks are the same. We have to manage the negative climate risks, absolutely. But we have to look for the risks that we can measure and manage, and the risks that we want to take. So I think a huge part of our discussion and decision-making should be about the positive actions, and I know we're going to talk a little bit about that today.
Absolutely. Now, Matt, if I could come to you, you're in a unique position because NZ Super is Crown-owned. It's big in New Zealand terms, small internationally. It's also one of the largest institutional investors in New Zealand and a big source of domestic capital as well. So you've got this ability to be agile, but you're also holding up a significant part of the New Zealand economy.
No responsibility. No responsibility. We like to call it small but perfectly formed, but small and significant will be fine. That's true. I guess we've got a very clear mandate, however, and our mandate is to maximise returns without undue risk, and our mission is to smooth out the increasing cost of the national universal superannuation in New Zealand. So while in a contextual sense we are an important part of the economy, we have a very clear goal. We've got a goal-dependent, operational independent framework, so very typical to central banks, that kind of thing. So we guard that operational independence very jealously, and our board is appointed by an independent nominating committee, and itself guards its independence from government decisions very jealously. So that's a really important part of our context, and I think the way that we think about our approach to the risk presented by climate change is that that context is really critical. I was thinking about the mock trustee session just before, and the questions around DB versus DC and whether that made a difference to the decision. That's all part of context as well. Talking to Kerry Pratt this morning, her fund is DB and entirely in runoff, has a quite different investment horizon to our fund, which is going to continue to grow through 2080 in nominal terms, even after we start giving money back to the government to smooth out that cost of future universal national superannuation. So the definition of your mandate and the context in which you operate is very important. We are a big fund domestically. We're highly transparent. We're subject to Official Information Act. We have that manifests in how we operate. We've published our board papers on our climate change strategy, a couple of those. We've published a whole lot of background documents as part of that I guess, a preemptive strike in terms of our official information, the requests we anticipate coming, we're already getting. But we operate in a very transparent way, and that's a critical part of that independence that we get. So that's important as we think about our context for the decision we made. I guess the other way to measure how we're going is whether we've upset everyone sort of equally. And when we announced our climate change strategy last year, which was about October last year, I think we managed to do that. So we figured we're probably just about right in terms of assessing what it is that New Zealanders care about. So some thought we'd done too much, some thought we'd done far too little, and that probably tells us we're getting there in terms of assessing what's important to Kiwis.
Now, Damien, you oversee $85 billion in investment, very widely invested as well across all asset classes. So it's really quite difficult in that context to get away from the effects of climate change, isn't it? What sort of strategies do you apply?
Thanks, Jeremy. I guess first thing I'd say, it is a large pool of assets and certainly a large, a very diverse pool of assets. But I think one of the things that's critical for any fund, First State's a good example where there are a lot of people involved in that process. So I can see some colleagues up the back there, Lisa McDonald, who's Head of Responsible Investments for First State, and Ross Barry, who's done a lot of work in this area as well. And I guess we have looked at the opportunity, as Deb said before, the risks and the opportunities, and certainly wanted to put in place a very robust plan, and that plan's been a number of years in the making, and certainly with regard to that plan, the execution of it is something that has been happening over the last sort of 4 or 5 years. And the plan really starts from a First State's perspective with a universal ownership lens. So in our context, universal ownership is really understanding the footprint we have as an investor across a broad spectrum of the universe. So whether that's the economy, whether that's the communities our members live in, retire into, certainly understanding that dynamic is very important when we think about how we should think about climate change risks or other risks as well. So not just climate change. But that's a starting point from our perspective, but it varies pervasive across everything we do from an investment perspective. And then, as I mentioned before, the plan that has been put in place from a First State perspective has a number of different legs to it. And it has been, through the last few years, the resources we've built up as a fund and certainly the execution we've undertaken to try to ensure that we can roll that plan out. And it's been really pleasing just in the 12 months or so that I've been at First State that the resources we've brought to bear in that area have continued to build. And I think from our perspective, and when I think about risk and opportunities, but certainly from risks and different investments, it's just about our ability to make good investment decisions. So, and I think about them as good quality decisions. And good quality decisions mean that you need to have a minimum level of understanding in the risks and the opportunities that you're thinking about from that investment perspective. And I think ESG risk, climate risk, they're all very, very important facets to that understanding of what's a good and bad investment. So the rollout of that plan has been very critical to ensure that from a climate change perspective, we've got the best information we can have to ensure that we've got the best opportunity to make good investment decisions for our members. And that's the continuation that we're rolling through at the moment. As I said, that started a number of years ago, and I'd expect it will continue. It's not I can't see the finishing line there, but certainly our goal is to ensure that we do that as robustly as possible so that we can generate those strong outcomes to members based on those good investment decisions.
Now, Debbie, I saw you nodding your head before when Damien was talking about good quality decisions. How do funds exercise that in the allocation of capital?
Okay, good question. Yeah, look, absolutely. I think it is about universal ownership and also about active engagement. So I think, the primary way that we're doing this in terms of how we allocate capital is through our engagement program, engaging with managers, engaging with the organisations we invest in. But I think it's also, being prepared to be bold in some of the decisions you make. And if I speak first of all, for example, about looking for the opportunities, at HESTA we invest about $2.4 billion in low carbon opportunities. So that's, across property as well as equities, etc. And that's growing for us. That's looking for those really positive opportunities. If we look at the other side of managing risk, there's a lot of discussion about stranded assets, and that certainly for us is a risk that we're very mindful of and that we believe needs very careful management. And so we've actually made a decision across the whole of our portfolio that we need to look at the fossil fuel area with respect to new and expanded assets. So it's not in terms of existing, and there are a lot of reasons for that, but we're prepared to make a bold decision. If you're going to put climate change, ESG at the centre of your decisions, you have to be prepared to make some bold decisions based on that.
Matt, I want to hear your thoughts on that, and also what you perceive some of the key challenges to be in implementing strategies and some of the organisational objectives for NZ Super.
I'll just pick up on the last bit that Debbie talked about, the issue around stranded assets and the risk, because that's very much where our climate change strategy was focused. So that comment I made before about maximise return without undue risk, that part of our mandate became a critical part of our discussion. So what we had to do was find a way to get buy-in from our board as well as buy-in from all of our investment teams, and actually come up with a framework that allowed us to have this discussion, so we're not sort of skating across some flat surface and people are ending up in sort of corner solutions depending on personal opinions. And so with the board, what was really critical around that was our investment beliefs, and to the point that Damien was making before, this is not an overnight journey. This is something that takes quite a long time. We've had a responsible investment framework at the fund for 10 years now. We've been thinking about climate change from a macro theme perspective for probably the last 6-7 years, and really have put the work and put the resources into to get to a decision from a climate change perspective over the last 2 to 3 years, and that culminated with that strategy. And that discussion with the board most critically rests with beliefs. So we have to start from some sort of framework and some sort of foundation that we can have the discussion. The discussion with the investment teams and the buy-in with the investment teams is really critically founded on that belief, but then the so what. So what do we do as a result of this? How do we think about this? How do we have that debate around those big questions? How do we measure the risk? Is the data any good? How would we mitigate that risk? What do we do about the different types of emissions, scope 1, 2, 3? There's a whole lot of questions in that you needed to have some framework on which you could hang the discussion, so that you ended up with a little bit more than a fact-free discussion. And we've slowly worked through that. It's taken us quite a while, taken us a lot of brain power, taken a lot of people, to what Damien pointed before. I think we've had about 20 of our investment team involved in different aspects of this climate change strategy along the way, and you had to bring the whole organisation with you, because when we're done, we've got to have the board there. We've had, I think, maybe 6 discussions with the board along the way as we've got to both the strategy that released in October last year, and then the implementation of that strategy in respect of our global equities in June of this year. A lot of discussions with them, but also a lot of discussions with investment teams. So it's a long process. It's like the guy that comes into the pub and says, "How do I get to Dublin?" Well, I wouldn't start from here. It's like that.
Damien, Matt talks about having a fact-free, or trying to avoid having a fact-free discussion, and the evidence base is really still growing. And there's not a lot to look at, and a lot of the evidence is called into question publicly, politically as well. And yet at the same time, we are seeing the impacts of climate change that's continuing to happen in very unpredictable ways. How do investors begin to deal with those impacts while still trying to look for the data that helps mitigate some of these risks?
I think it was talked about before in the panel. I sat through the end of that panel, and I thought the discussion, the points around scenario testing, analysis is very critical, because that is, I think, a very good way, not just for climate change risk, but for risk in general, to understand how to adopt a sensible approach when investing clearly is not black and white. There's lots of grey, there's nuancing to it. So to ensure that we understand the potential outcomes and probability weight them as we can, and then make sure we're positioned from a portfolio perspective for those that look more likely to occur, and then respond to that. And I think that's, as you mentioned, Jeremy, the adaptation side of things, the mitigation side of things, they're both key parts to this discussion. I think one of the things and again, there's lots and lots of exciting stuff happening at First Day, but one of the things that I sat down with one of the team who focused on the engagement with corporates in Australia the other day, and it's fantastic to see how we're trying to ensure that we're taking real information back to the corporates we invest in, because that's when the rubber hits the road. And I think from my perspective, until we can do that, it's not the only way we'll affect the outcomes, but I think it's a very important way we'll affect the way that we're investing in corporates in Australia, to really help them to understand how investors are thinking about that, how we're thinking around the scenario analysis that we think is relevant to them as a company that we want to invest in or not. And that universal ownership is very critical, because for most companies, we don't get the choice to divest. If we're holding the index, for instance, most times we'll hold every company, obviously generally we'll hold every company in the index. And so we really need to, where we can, engage proactively, productively, to drive better outcomes for those corporates and better investment outcomes for us as investors and for members, obviously, at the end of the day. So that was a very exciting meeting for me the other day, just to get a sense of how we're thinking around this deep analysis, really understanding the scenarios that flow down into the earnings of companies, that we can then take back to those companies to say, how are you thinking around these particular issues, because this is what we're sensing as risks.
Matt, what do you perceive some of the key challenges to be going forward, particularly when you're sort of liaising with outside organisations who have different levels of, governance and outlook on what the risks are and how to best manage them?
I think starting point of beliefs is critical. So I'd I guess echo a little bit of what Sarah said on the last panel, which is I think we're past evidence now, where we've the TCFD, the opinion from, or the speech from Jeff Summerhayes, a view of APRA, the Australian Directors' Duties opinion. We're sort of the Paris Agreement. We're kind of through evidence. We're now in this kind of the so what phase, and the key challenges there become this point about uncertainty. So we know that this effect is happening, and we know with, I think the words are with reasonable certainty, or that it is caused by us. But then, so what do you do with it? So you can have debates about, is it in the price? How do you measure it? What's an appropriate mitigation strategy? But that's where you're having the debate. You're not having the debate about, are we in this warming world anymore? And for us, the challenges then become questions about data. So there's pretty good data on public companies. In fact, when we did it recently in relation to our global equities, I think 97% of the public companies in the index that we had reasonable data on, and it's only the last three that the providers, in this case MSCI, was making assumptions and using proxies for that. Private market assets are really hard. So there's still a big issue for those funds and those investors and asset owners that have a lot of private market assets, how they measure the risk and this sort of stuff. So you'll get issues around data. You'll still have debates. The most fundamental debate will be, is it in the price? Is this already reflected? Where we landed at New Zealand Super Fund is, the reason we've taken this approach is we think that there's a risk from climate change that is not properly reflected in the price, and that's both a tragedy of the commons, and as Mark Carney describes it, a tragedy of the horizon. So investors' horizons and their use of a mispriced common good, that is the atmosphere's ability to absorb CO2. So as a result of that, we think markets don't properly compensate us for that. We need to deal with that risk. We will have plenty of debates with people who say, well, actually, I just think it's in the price, and so then I don't need to do anything about it.
Jeremy, can I just add to that? One of the things that I heard Alexis Chang ask a question before. So one of the things that we did when I was at State Plus was we undertook with Mercer, and there was a number of different organisations on that, a study into the so what, how much does it matter from a risk and return perspective with regard to the four potential, as Mercer and the partners of that study tried to define the four potential outcomes for the pathways of emissions. And the challenge that I had, again at the CIO level, was that the outcomes weren't impactful enough to really drive huge gasps in the room with regard to the investment committee. Now, it was very good information, but it is, and to Matt's point, it's very difficult to have great clarity when you're probability weighting outcomes across different scenarios to then come up with something that looks impactful enough to say, gee, well, that's the obvious course we should take. And I think that may evolve over time, and I hope it does, and I think we can all contribute to that discussion, but it is a very difficult journey to say, well, that's the obvious path, we should definitely take that. Given where we're at and given the analysis that I've seen, maybe there's there's better up-to-date information or there's different up-to-date information. But from what I'd seen, there wasn't obvious outcomes from that type of analysis.
It's a microcosm in many ways of the sort of debates we see taking place publicly, particularly between politicians and the public, about being so far beyond science and yet trying to take an organisation or a society with you. Debbie, how do you manage that? I know HESTA has just recently updated its climate change policy. How does climate fit into your investment outlook? And then how do you sell that to the organisation and say, this is what we stand for, this is where we're going, and then selling it to your members as well?
Yeah, look, I think it takes time, and I think you build it over a very long time, and I think we're incredibly fortunate at HESTA that the journey for us started a long time ago. And so the alignment we have through the organisation, from the board, through management and through to our employees is enormous. And such a benefit to us, that culture, where we all really value this and think it's incredibly important. We're probably also fortunate with our sector being health and community services. We're not in the coal mining sector, for example. I think we have tremendous alignment from our members as well, which obviously is very empowering. But, I think I'm reflecting on what Matt and Damien have said. It is about data. It is about that groundswell of information and data that is being created and that we can all share. I think it's also about, to some extent, creating your own data. And, looking at your portfolio and doing the things that you can do to create your own view of where you sit. Be that measuring carbon, and be it measuring and engaging with managers and getting their insights. You can't do it all, and I do agree with Matt about, obviously, unlisted markets have more challenge, but you have to start somewhere and gathering your own information, because at the end of the day, data is incredibly empowering. And I think that's been part of our journey, is gathering that information.
We're going to have come to questions from all of you in just a moment. And before we do, Damien, I want to ask you, Debbie speaks about opportunities. I want to know where you think those opportunities lie.
Well, I think we've been investing, like a lot of people, or looking for areas in renewables and that area of the climate change impacted marketplace. And certainly we've been investing to some degree in there, but it is a little bit challenged with regard to pricing. But certainly that's something that we've been trying to put money into. I think the other part is the emerging technologies, and I think that's an area that we've struggled more to put money into that type of investments. There hasn't been a lot of what we term as being institutional grade at the moment, really that sized investment that we can put material investments into. So even in the early stage of the venture capital end of the marketplace, there hasn't been a lot of opportunity that we've seen or that we've looked to pursue. So it has been more on the renewables side of things. But again, I'd say it's like all investments, we need to judge the risk and returns of it. And I think whether it's fully priced in, I'm not sure, but some of the renewables opportunities look like they're fully priced. In the most recent periods of time, the last couple of years, they've become more fully priced. So we've been struggling to get additional money into that area of the world, although we are seeing some opportunity in more emerging market areas of renewables.
All right, let's come to questions.
Yeah, hi, Julian Poulter. Question goes to returns on the clean side, I guess. The largest clean listed companies in the world, probably Dong Energy and Tesla, at 40 to 60 billion. The largest dirty companies are between 300 and 500 billion. So, your investability is really small, and you're going to unlisted and so forth. We've seen the collapse of Yieldco, Sun Edison and so forth. Isn't it the case that you're going to have to really adjust the risk premiums on the clean side to accept lower values, and possibly even add them on the dirty side as well, as part of doing your scenario analysis and essentially tilting your portfolio?
Matt, did you want to take up this question? It's about sort of pricing in that you were talking about.
Well, implicitly we have done that in what we've done with our passive global equities. So we started the implementation in our passive global equities. We said we'll define carbon exposure as carbon emissions intensity as well as carbon reserves, and we'll downweight our exposure to those companies and effectively upscale everything else on a market cap basis. So we have tilted our portfolio against the bigger dirty companies that you talk about, the oil and gas, the coal. That reduced our exposure to utilities and oil and gas and materials sector, and upweighted it to effectively IT and financials and TNT. So we have done that. I think to Damien's point before, all of this is risk and return. We don't sort of look at this and say, well, there's an unpriced factor in those renewables at the moment. You're always going to look at what the overall risk return profile is of whatever sector it is. I think some of these sectors we tend to see too much money chasing too little opportunity, which is the point you're making. In which case we won't start with those. I think the key point for us is we started with a risk mitigation approach, and that's where we've gone in the first bit of the implementation. We'll get through to the search for new opportunities as we go, but we're not compelled to go chasing those because we've got a reference portfolio that we think is going to meet our mandate in any event.
Damien, did you want to comment on that point as well?
I mean, I think these opportunities will keep developing from a clean perspective, but I think your point's valid that the general size of opportunities greater in the more traditional companies which are not as focused on clean tech or clean areas of the market. So that's clearly where most of the money's sitting. I think the point I was trying to make earlier just around the work that we've been doing from a direct equity perspective, and it's Australian focused at the moment, is to really understand how we can judge from a climate change, climate risk perspective, in this particular example of a company, what our scenario looks like with regard to the market pricing. So again, it's trying to understand, is that fully priced in? What's the market pricing in around the cost of carbon, for instance, all those sort of factors. And where we can see an opportunity, then we can engage with the company, but also potentially think, gee, there looks like an opportunity for investment. So it is that understanding in a carbon adjusted world, which again is not necessarily the place we're living in today.
Debbie, did you want to add anything to that point about how things are priced in?
I won't add in the detail, but I do think it's incredibly important to remember that we are long-term investors. And look, that probably complicates it to some extent when you're trying to work out the price of things. But it is, that we're in it for the long haul. So it's not just this year or next year or the next 3 years.
Any other questions?
I was interested in some of your conversations about engaging or directing with single companies, because a lot of funds will have an outsourced investment model where I'm just linking the previous mock board conversation to this panel, where often you have no control over the individual securities that are purchased. So I wondered whether any of you could shed any light. Do you think that asset owners in Australia and New Zealand need to drill down a further level and get more familiar and involved in individual security names, or do you really think that the onus needs to be more decisively put on managers to do that for you?
Debbie, I'll come to you for this one.
I think it's absolutely both. Investment managers play such a critical role, and we obviously engage a lot with our investment managers because they play that very important role, especially in terms of active management. But, at the end of the day, we are the asset owner, and so our responsibility to engage with the organisation is critical. And, we might choose to do that, for example, through the Australian Council of Super Investors, but we are heavily involved in that process and really want to understand what those companies are doing about the key risks and opportunities.
Damien?
I was just going to say, I think the strong focus will be at the highest level, Alexis. So we're not looking to engage with the 300 Aussie companies in the ASX 300, but certainly on a targeted basis to try to understand. And it may come back to specific companies or an area of the market that we want to engage in more, or a risk that we think is heightened. So I want to understand that area more. So I think it's quite targeted. I think to reflect on Debbie's comment, certainly investment managers are very key. They're very close to the companies they're owning as well, the active ones. Passive ones, clearly a lot of the passive managers do very, very strong engagement as well. So there is a spectrum that we want to make sure that we're understanding that full spectrum.
Matt, I know you're a big supporter of active engagement with...
Yeah, I think you just got to decide where you've got the most leverage and the most influence. And so we engage directly with New Zealand companies. We have, as Jeremy said at the start, we're a pretty big institutional investor in the New Zealand market, and so that's where we can have specific direct engagement. We engage internationally, generally under either UNPRI engagements or collaborate with other peer funds on specific engagements, which we are doing directly, but also use an external engagement partner as well to assist. So it depends a lot where you want to direct your resources. We also have a big chunk of the portfolio that is passively managed, and those managers, which are BlackRock and State Street and NT, run significant engagement programs as well. So we're involved in at the principal level in terms of what we care about. They're doing the active engagement, but it'll differ by where you have the most influence. We have a lot more influence in New Zealand than we do with a large listed US public company.
Hi, Pablo Baruti from CFS GAM. You just talked a little bit about pricing of things in and around risk, and I just wanted to perhaps ask you to elaborate a little bit more on how you define risk. Is it variance from a benchmark? Because to Julian's point, those fossil fuel companies being much larger just is all that much more money that you can lose. Is it variance from a benchmark? Is it permanent loss of capital? How do you think about risk when it relates to something like this? Because I think you could talk about the pricing in of, say, smartphones for Kodak, but it wouldn't have mattered because it's not worth anything anymore. And so I'm just trying to, I guess, get under the bonnet a little bit about how you think about risk in relation to this.
Well, I think from a broad risk perspective, we are more focused on the probability of meeting a CPI plus return. So that's the primary risk. Obviously, the inability to meet that can come in lots of different ways. We also care about relative risk, but at the end of the day, we just want to make sure that we're paid for the risk we're taking. So, and being paid for the risk we're taking, we need to do as much work as we can to understand what those risks might be. But typically, it is how likely are we to meet that CPI plus outcome over a long period of time. Debbie's very right that let's not get too confused over the next 3 months or 6 months. Where most products that most superannuation members have got their money in are investing for 7 or 10 year type time frame. So what's our probability of success over that period of time? And so it is an absolute focus. But there'll be nuancing around the relative focuses as well, where it is back to a manager or how we're trying to attribute risk across different lenses.
Yeah, we're not thinking about this in an active risk sort of comparison to a benchmark way either. Same concept. What are the range of outcomes? So what of ultimate outcomes, long-term outcomes for us is we were involved in the Mercer work as well. So what do we care about there? We care about what's the range of outcomes if carbon suddenly gets priced properly, some sort of market pricing. What's the range of outcomes if we end up in a 4-degree world? So it really goes, I guess, to your point about permanent loss of capital. At a portfolio level, it's what's the range of outcomes that you could expect if some of these scenarios manifest or when some of these scenarios manifest.
And Debbie, that comes back to the point about data that you were making earlier on as well.
It does, absolutely. And I think, Jeremy, in your introduction, you spoke about how much has changed in the last year. This is such a dynamic area and things are changing fast and probably fast and slow. There are things we thought we would have earlier, maybe especially in Australia, and we haven't achieved them. So it's incredibly dynamic, and I think that's why to stay on top of those risks is so critically important. We never have this done. We never have it all sorted and the risk assessed. It's an ongoing thing that we're going to have to do all the time.
Hi, Bill Hartnett, Local Government Super. Matt, and a question for Matt, but for all of the investors here, Debbie and Damien as well. Matt, you come from a country with a carbon price and a fairly settled carbon policy in compared to Australia. How much do you think that helps or hinders you in developing what is a really well-advanced approach to addressing carbon risks? And I suppose, in comparison to what we see in Australia.
I think our ETS, our history with the ETS, probably informs some of our nervousness about policy risk in this space because, you go back a few years when I first started at the super fund, we were getting a lot of pitches for here's a carbon farming approach. We're just going to find a whole lot of marginal land, we're going to plant it with trees, we don't care if we ever chop them down because we'll get all our money from the carbon credits, and of course we then suffer the GFC, we import a whole lot of Ukrainian credits which are available because they're not producing anything in Ukraine anymore, and suddenly our carbon pricing mechanism doesn't work anymore, and all of those. So that sort of highlights some of the sort of design risks around some of these things, and that's one of the things that I know our government is thinking about, and our Productivity Commission is thinking about as we sort of figure out how we can transition to a low carbon economy. So it's helpful to have it. I think part of the design feature meant that we didn't get the proper carbon pricing response. I guess you could have an argument, there's plenty of economists in the room, I'm not one of them, who can have an argument about whether it's the proper response or not, but for the design it didn't really work to send the price signal. So I think we still think that is a useful way to go, the ETS structure, but is it possible to get that working properly as you like in practice, or is it easier just to go to some sort of mandated pricing? I know Canadians are looking at having stepped pricing over a number of years, so some floors so that you actually get towards a long run level that you think is sort of sensible from a pricing perspective. And there's been some good work done on what is the right price for carbon. So that's just a relationship between how much damage you're going to do to the world by releasing that CO2 and the cost of mitigation. So I think that it goes two ways on our experience.
Debbie, can I come to you on that point, because we are a far more polarised country than New Zealand is?
Yeah, I think this is a very difficult issue because, I mean, clearly we need action on climate change, and I think everyone would agree with that. The issue is what action. So look, I think it's a very complex matter, and I think it's great to hear Matt speak about even when you have a solution, to actually get the solution right and perfect is a challenge.
Damien?
I mean, I was going to just steal a colleague's thunder for tomorrow, but Christian as well, with regard to the report that's been done. It's called Coal, Carbon and the Community Report. And reading that report, I thought, gee, it's a nuanced topic, isn't it? That, in effect, there is so much interplay across the economy, across society, in all these sort of issues, that it's. I can imagine it's very difficult for politicians to understand the dynamics. I think that we would suggest that more certainty would lead to more investment in various areas, and that's a very important outcome, I think. But I do think there's some nuances to this whole topic. There's no doubt.
Just had a follow-up question from, I think it was Pablo, asking about how you define risk. How do you factor in the systemic risk dimension? And by that I mean the potentially unpriced value of contributing to the collective management of systemic risk, to which everybody, all portfolios are indirectly exposed. So it's, in addition to your direct individual portfolio risk exposure, and has a financial materiality as well. So you could say that that when you're considering the risk-adjusted return, how it stacks up for potential positive investments, should you be factoring that in as well to further bolster the investment case for it? And I guess just picking up on this question about carbon markets, is that something that you see as potentially interesting in terms of opportunities for institutional investors going forward? If and when the global carbon market really picks up and takes off again, could it be, in terms of primary, secondary, tertiary carbon markets, is that something that you might be starting to look at quite seriously as a potentially separate opportunity as well?
Damien?
I'm happy to, maybe the second part, but I'll try to answer some of the first part. Look, I think you'd need to be fairly brave to put lots of money in an Australian market, obviously when and if it becomes live and operating in any meaningful way. So I think there'd be a proving period of time. It might be a great opportunity to do that over a longer period of time, because I think we agree. Certainly, I agree with Deb's point that there's a lot to be done that would be supported by a carbon trading environment of some sort. So that could be a good opportunity in the length of time, but obviously a lot of understanding would need to be got beforehand. I think the first part of your question, if I understand it properly, was to do with how do we think about risk in the positive, with a positive lens as well, and how do we think about that from is there a positive climate change impact opportunity, and how does that fit against the portfolio from a negative perspective? Is that what you were? I think that's really at the core of a universal investment focus from our perspective. Now, we're obviously just one participant of the market. We think we're growing to a size that means that we need to understand the footprint we have in markets, particularly the Australian capital markets, but even starting to be more broad than that. So I think there is that concept of how do we understand the positive and negative implications of what we're trying to do, and that can be climate implications, it can be broader implications, societal implications, etc. So I think we're trying. It is a very difficult thing clearly to do, but trying to understand the full fabric of that perspective is at the centre of universal ownership.
I also think there's an element of why it's so important for us to work together as funds, because it's not just about our portfolio, it absolutely is about the Australia that our members will retire into. And that's really why we're here. That's why we share ideas. That's why we want to work together, because I think together we make the system. And we've got to always be mindful of the influence that we can have, but also the risks that sit there for all of us.
Matt, final comment from you?
The issue around how we think about factoring that into investment hurdles is something that we're grappling with at the moment. So the first bit of dealing with the passive public markets was one thing, but how we factor this into our risk allocation and our investment hurdles and our cash flows is a whole other question. I haven't quite got my head around how you take the benefit of a marginal decrease in the systemic risk in the whole thing into your investment considerations, but I'm sure that we can discuss that over a beer later, Justine. Justine used to work for the super fund, by the way.
I'm afraid that's all we have time for, but the three of you are going to be at dinner tonight, and I'm sure you wouldn't mind being bailed up at all. You're off. But please thank our guests, Debbie, Matt, Damien.
Good afternoon, ladies and gentlemen. As the Chair of the Investors Group on Climate Change, it gives me great pleasure to formally welcome you here to the IGCC 2017 Investor Summit. And on behalf of all the members of the IGCC Management Committee, I want to thank you for taking the time to attend this important day. I would like to take this opportunity to provide you with an overview of some of the international advocacy work that the IGCC has been active over the last few years. As many of you in the room would know, the investment industry is truly global. There are risks and opportunities in all markets. Australian investors have a very international outlook in pursuing projects with the right risk and return profile. Climate change is a global problem. It requires unprecedented levels of global cooperation, collaboration and engagement to solve the issues. It requires government, civil society and the private sector to play a major role. As you may be aware, the IGCC works in partnership with a number of regional and international investors groups to tackle this issue. Through the Global Investors Coalition on Climate Change, we work with investors organisations in Europe, US, Asia to support a global response. We produce joint research projects and develop joint advocacy projects to ensure that investors have a voice in the climate change debate across the globe. And recognition of the importance of the investor is growing, not only domestically but also globally. This year, I was proud and pleased to represent the Global Investors Coalition in Rome at a special roundtable conference with His Holiness Pope Francis and business leaders to discuss the major social and environmental change of our time. This conference was convened by the Global Foundation. The work of the IGCC was recognised at the roundtable as a crucial vehicle for solving climate change problems. The 4 Investors Group also have joined with the UN, the Carbon Disclosure Project and the PRI to develop and launch a major new investor statement to the G7 and G20 governments, calling for a strong climate change response. Around 400 investors, representing 22 trillion in assets, jointly signed the letters that went to the G7 and G20, including many of the investors in this room, so thank you. IGCC is playing a major role to support the re-establishment of the Asian Investors Group on climate change. Last month, I was pleased to join CEOs and CIOs of investors in Asia with the former US Vice President Al Gore to discuss climate change and investment opportunities in the Asia region. This followed a similar event in Australia where Al Gore joined IGCC to speak to Australian businesses on the state of climate change response. Finally, on the 29th of September this year at the PRI in-person event in Berlin, we came together again to kickstart a new project. The project is called Climate Action 100+. We are asking all investors to sign up to a new 5-year deal to engage the largest emitting companies in the world to encourage them to reduce their emission and strengthen the climate change governance and reporting framework. I encourage everyone in this room to join. As global investors, we must support a global response to climate change through collaboration, action and engagement. So as Chair of the IGCC, I again thank you for joining us here today to discuss more about the investors and the finance community to manage climate risk and opportunities and to keep the global warming below 2 degrees. And thank you for being here.
It now gives me great pleasure to introduce Mary-Ann Thomas, who's the Member for Macedon and Cabinet Secretary for the State Government of Victoria, to provide some brief remarks. Somewhat suitably, Mary-Ann's actually worked for 25 years across public, private and community sectors, including previously working at a bank, so she speaks the lingo, it would be fair to say. Mary-Ann was elected to the Victorian Legislative Assembly as the Member for Macedon in November 2014 and is currently Cabinet Secretary in the Andrews Labor Government. Please welcome Mary-Ann.
Thank you very much and good evening, everyone. Before I begin, could I acknowledge the traditional owners of the land on which we meet and pay my respects to their elders past and present. To Frank Pegg, the Chair of the IGCC, to Emma, your CEO, ladies and gentlemen, it really is a pleasure to be here with you this evening, and I was reflecting that I think I have to unlearn how to speak corporate ease in order to be an effective Member of Parliament, but sometimes it can be a challenge to lose some of that language that we learn and that of course is quite mysterious to ordinary people on the street. Now, the Victorian Government, through Sustainability Victoria, is delighted to sponsor this investor group on climate change's annual summit here in Melbourne. The Victorian Government, as you probably know, I hope you know, is committed to restoring Victoria as a climate change leader here nationally and around the world. Some of the action that we are taking here in Victoria is both legislated and we have a range of programs being led, of course, through Sustainability Victoria. We have, since coming to power in 2014, delivered a new Climate Change Act that was passed this year and commences indeed on the 1st of November of this year. The Climate Change Act legislates an emissions reduction target of net zero by 2050 and creates a policy platform to help support a timely and equitable transition of Victoria's economy to a low emissions generating economy. We have, of course, also released our climate change framework, which outlines how we will get to net zero by 2050, and we've released a 2020 adaptation plan. Underpinning all of this work, we have launched and continue to deliver our Take Two Climate Change Pledge program, which is delivered by Sustainability Victoria and will help and helps inform our state government targets. Take Two is a whole-of-government program that asks participants to pledge their commitment to achievable actions and help keep the temperature rise to under 2 degrees. In the room today, I know that we have representatives from many Take Two founding partners and members, including NAB, Australian Ethical, ANZ, the Carbon Market Institute, GPT, Lend-Lease, Mirvac, Vic Super and others. And I thank you for joining us as leaders in our Take Two program. In fact, the program now has 650 different organisations with operations in Victoria now participating, and we acknowledge each of those businesses and local governments who are often leading the way. One of the great things about the Take Two program is that it works across sectors and it uses the power of different groups coming together to drive collective action. Just as Frank also discussed, we need our civil society, our government and of course business all working together. So I would like to encourage those of you who have not yet done so to join the Take Two Pledge initiative. Pledging is easy, of course, but it also takes into account existing commitments and involvement in other climate change initiatives. Take Two offers a platform for climate change leadership, gives advice and guidance, and provides access to our growing network of members. So I encourage you to get on the Sustainability Victoria website or speak to a staff member from SV today about how your organisation can get involved in the Take Two Pledge program. Now, speaking of leadership, the Victorian Government has a strong focus on an unashamed strong focus, I might say, on transitioning to a clean energy future. We are committed to developing renewable energy here in Victoria. And we understand that industry is looking for policy certainty from governments. And I have to say that it is something I know that industry is struggling with here in Australia at this point in time. But in Victoria, we are clear that we know where our community wants us to go. We know where the world is headed. And so we, as I said, remain unabashed in our commitment to transitioning to a clean energy future. And to that end, the government has introduced the Renewable Energy Bill 2017 to the Parliament, establishing the Victorian Renewable Energy Target, 25% by 2020 and 40% by 2025. The VRET will support capital expenditure of up to $7.2 billion in renewable energy programs, which will result in about $2.1 billion of direct economic activity in Victoria. We are also committed to this clean energy future because as a Labor government, we know that this is where we will drive new jobs into the future. We believe that our commitment will create up to 10,000 two-year construction jobs over the life of the scheme, particularly in regional Victoria. And as a member representing a regional electorate, I can tell you how important it is that we continue to support a diversified economy where we are seeing jobs being created in regional Vic. Now, the transition is also key for our communities, and I'm very pleased and proud of the work that Sustainability Victoria is doing in establishing its Community Energy Hub pilot program across Bendigo, Ballarat and the Latrobe Valley, supporting these regional centres, well, in the case of Bendigo and Ballarat, of course, significant regional cities, to access the skills and expertise required to develop and deliver community-based renewable energy projects with local ownership, participation and benefit sharing. Again, reflecting on my own community, this is something that we are particularly interested in. My electorate, which some of you may know because it's not that far from the city, but it's made up of many small towns, communities that are passionate about taking control of their own energy futures and indeed taking decisive action to combat climate change. So just as a little anecdote, I suppose, I look to communities in my electorate, Woodend, Daylesford, Kyneton and others, and what you see is communities that are generating their own solar, their own wind power, and they are working closely with our local governments, indeed, and doing some really innovative waste to energy programs as well. So there are projects afoot, both at the very large scale and at the more micro scale, and it's fascinating to watch a town like Woodend work towards a future where it generates all of its own energy. Now, I'd like also to talk about some of the social research that Sustainability Victoria has undertaken that demonstrates strong support in Victoria for action on climate change. A survey of more than 3,000 Victorians found that 91% of all those respondents accepted some level of human contribution for climate change, and the research found that Victorians want and expect action from all sectors of the community. Over 85% of respondents expect action from us, the state government, business and industry, local government and individuals, as well as that holy grail, leadership from our federal government. The research found that 73% of people are prepared to support businesses that are taking action on climate change, and that 80% of people support the Victorian government's renewable energy targets. Of course, over 75% said that they would support large-scale renewable infrastructure in their local area. So together, what these figures show us that there is a lot of support for action on climate change in our community, and that people are expecting that action to be taken. So to help support this action, Sustainability Victoria is also providing a free investment facilitation service. So the way that service works is Sustainability Victoria works with project sponsors to provide guidance on the regulatory requirements for renewable energy projects, as well as connecting them with financiers. And the service talks through legal structure options and provides example contracts, models and cash flows. So of course I am very well aware that I am the speaker that is now standing between you and drinks. So again, and finally, in conclusion, can I thank you again, thank the Investor Group on Climate Change for their leadership and the opportunity to bring all of you together for what I'm sure will be a very interesting summit, and I congratulate you all for the work that you are doing. So thank you, please enjoy.
Thank you, Marianne. And I'd now just like to introduce actually the last speaker between us and drinks. She's also the sponsor of the drink, so it seems entirely appropriate to introduce Steve Lambert, Executive General Manager for Capital Financing at National Australia Bank.
We committed to undertake $18 billion of financing activity to help transition Australia to a low-carbon economy and support climate change.
Clean energy is an integral part of our business. The combination of some of the world's best wind and solar resources, rapidly falling technology costs, and bipartisan support for renewable energy
provides Australia with a tremendous opportunity to decarbonise the electricity sector.
We believe the assessment of climate change risks is an important part of our decision-making process.
We are committed to assisting our customers and communities in the orderly transition to a low-carbon economy.
And supporting our communities and the environment.
In practice, this has meant building out renewable projects, driving investment and jobs in regional communities, and importantly, delivering green, clean power.
Right, thank you. Okay, so it's always frightening watching yourself on the big screen, and you absolutely are right, I am the last person between you and drinks, so I'll do this pretty quickly. So we're really proud at NAB to be involved for our second year as a gold sponsor of this event. We really believe the IGCC are really answering a need in the community. We're really pleased with the work that they're doing, and we're very proud to be associated with the group and want to continue to do more with all of you here today. Really pleased also around the focus on climate adaptation finance. I mean, it is a big thing. It's something that we've been trying to get our head around really for the last couple of years in terms of our own book from a risk point of view, but also ultimately from an opportunity point of view for Australia. I think it is really interesting. It is actually quite nuanced as you get right into it. But I think it's really good. The more people looking at this, the more people talking about it, the more chance we're going to get something done. The video sort of talks a little bit about we have a long-standing commitment to renewable energy as a business. In fact, when we started this business, it came out of our activity, I guess, broadly in the utility space. But since about 2002, 2003, we've been involved across multiple technologies in the space, both here and also really from the early days in the UK. Increasingly, we talk about clean energy in a broader sense, and in fact, recently more broadly around environmental finance. But with the work that we've done in UK and the last 3 or 4 years in Europe, as well as in North America, we've got dedicated teams around the globe working on these issues. And really, we've benefited from being able to bring back ideas and technology and thinking from offshore back into the domestic market and vice versa. So it's been really important for us. We are really proud to be the number one arranger of project finance in the renewable sector in Australia, and we have been that for a number of years. I think we're actually, bizarrely, I think we're top 5 globally as at the half year. Now, whether or not we're there at the end of the year, I'm not sure. But the point is, we're making a really major push into this. It's a really important part of what we do. And we're always looking at new ways to innovate broadly in the space. We're very proud that we brought the first green bond to Australia in December 2014, and subsequently first green securitisation, and then the deals for both Victoria and the Queensland government over the last couple of years. We also really believe that as interest in progress grows in the SDGs, the Sustainable Development Goals, that's also answering a very specific opportunity set and a very specific need in the community. Again, we're very pleased to have brought the transaction recently, I'll say May, I can't remember when we did it. It was a few months ago anyway, for Australian Catholic University, which was the first sustainable bond in the domestic market, and we really hope that this is going to be a kick on as well. We're at the moment, because we have such a large part of a reasonable chunk of the balance sheet in renewables. We're also in the market at the moment with a pilot of a low carbon debt fund that basically allows people to sort of, if you like, co-invest with ourselves in renewable projects. Allows people to sort of, if you like, use the expertise that we've built up for the last 14, 15 years in the space and jointly work together on things. And I think this is going to be another interesting phase for us as we sort of look at how do we sort of work in a different way with the core investors, particularly in this case in a unitised product sense, rather than just single assets, which is historically where we've done a lot of our work. So our number one position in clean energy finance areas is one that we really do value highly. We're committed to evolving and innovating, just sort of stay at the top. I know I'm not the only bank on this panel. I see a good friend of mine, Christina Tonkin, in the front. So it's great that we've got some great competition going in the sector as we're trying to continue to innovate, and that's something that we're definitely into and something we're committed to. So with that, this is the end. There are drinks outside, so please go outside, have some drinks. I think dinner starts at 7, and I believe you've got access to the balcony as well. We'll have to have a drink with you in the next few minutes. So thank you very much, and thank you, IGCC.